guys, welcome to our first accounting lesson. In today's lesson, we're going to discuss the basic of accounting, wherein we're going to cover the rules of accounting, accounting classifications, and example. So without any further ado, let's get to it. First of all, we're going to start with the rule of accounting. So remember, this is a rule, it doesn't change. It's very advisable for you to grasp it now, to know it, to understand it, and not cram it. So today I'm going to help you guys understand this rule. So this rule states that asset equals to owner's equity plus liability. However, this does not imply that equity is equals to 50% of asset or liability is also equals to 50% of asset. This is not applicable. What I'm trying to say is that there can be a point wherein your asset equals to 100 Rand and your owner's equity is also equals to 100 Rand with zero effect on liability. And there can also be a point wherein it's 50-50, 50 equity and 50 liability. So it depends on your transaction. However, the left side and the right side has to balance. So okay, fine, let's get to each element. Let's start with our asset. The rule of accounting says that, okay, this is an asset. It says that our asset increases on our debit side, this is the debit side, and it also decreases on our credit side. Okay, fine, and then our asset decreases on the credit side. So before going forth, let me start with the definition of an asset. An asset is an item of value owned by a person or a business which enables a profit to be made. Okay, fine. So let me highlight the key elements of this definition. It says that it's an item of value. First of all, an asset has to be an item of value and it needs to be owned. Secondly, it needs to be owned by a person or a business and it enables a profit to be made. Okay, so let me make an example wherein we're going to make an example of an asset wherein it's going to prove this definition, whether this is an asset or it's not. So our definition is going to include a company, a clothing company. Let's call it ABC Clothing Company. So this is ABC Clothing Company. It manufactures clothes. Okay, so this is a short, guys. Doesn't look like a short, but it's a short. And then, okay, fine. For ABC to manufacture this clothing, is going to need a sewing machine. So this is a sewing machine. Okay, this is the sewing machine. So now let's prove whether this sewing machine is an asset to ABC. First of all, it needs to be an item of value. This sewing machine is 10,000. So which means that it has value. First of all, it has value and it's owned by ABC. Yes, this sewing machine is owned by ABC. Which is a business or a person. ABC in this case is a business, and it enables profit to be made. For ABC to make profit, it needs to do the sales of clothing items. So this machine produces those clothing items, which means that this machine is an asset to ABC. So now let's say that ABC buys another machine. So now we're going to have to look at the effect in our accounting journals or accounting T account. So now ABC buys another machine, which means that now ABC has two machines. Therefore, the machines are increasing, which means that you're going to debit the machine, the new machine that ABC bought. However, if now we're saying that ABC decided at the later stage to sell one of his machines, which means that out of the two machines that ABC had, it has decided to sell one, which means that now the machines have decreased. Therefore, if we are making sale of an asset, it's going to decrease on our credit side. So this is how this rule or this rule of accounting applies. So whenever you get a transaction, you have to think of it in this way. So you need to make it a practical example. So fine, okay, fine. Now let's get to our owner's equity. Let's get a new page. Okay, let's start with liability first. Starting with our liability. Okay, the rule of accounting says that this is a T account, this is a liability. There's a debit side, there's the credit side. So this rule of accounting says that our liability decreases on the debit side and it increases on the credit side. So remember, we're still using this ABC example, the ABC clothing company example. So, but however, in this case, we're saying that ABC clothing and this is a shot, guys. Doesn't look like a shot, but tell me. Okay, well, let me tell you it's a shot. Okay, fine. So now we're saying that ABC Clothing decided to get a loan from Z Bank. So this is Z Bank. So I'm just gonna draw something like a house here, and let's just call it Z Bank. So now Z Bank is going to give ABC money, and now ABC has the obligation to pay back the loan. So now ABC has got the obligation to pay back the loan. So now let's go to the definition of liability and then apply this example and check if this example qualifies as liability. Liability is said to be an amount owed by a person or business to another person or business. Okay, so let me highlight the key elements of this definition. It needs to be amount. First of all, it needs to be an amount. Okay, fine. It needs to be owed by a person or a business to, this to is very important, to another person or a business. So if this was maybe a normal person, or a normal person, natural person, it was still going to be applicable to this example or to this definition. So now let's look at our example. Say that it owed 100,000 to make it more realistic. Okay, fine. So now let's tick and let's check whether this example meets our definition. So is there an amount? Yes, there's an amount of 100,000. Is it owned? Is it owed? Yes, it's owed by who? By a person or business, which is ABC. The reason why we're saying that ABC is owing the bank is because ABC has an obligation to pay. There needs to be an obligation to pay. For example, if I'm giving you money and then I do not expect that money back from you, then it's not a liability. It's me giving you money. However, but if I'm giving you money and then I expect you to pay back that money, or the liability stipulate, or the contract stipulates that you need to pay that amount of money at the end of 2 years, at the end of 3 years, then that's where the owed come from, or the obligation to pay come from. Now it's owed by a person to another person or business. So now this amount, this 100,000, is given to ABC Clothing. Now ABC Clothing has the obligation to pay this amount to, now this is where the to definition is made, to Z Bank. Sorry for that. Okay, so now let's look at our debit and our credit, how this affects our debit and credit. Okay, fine. So now we're saying that ABC owed money from Z Bank. Therefore, the loan or the money is increasing because now I have more money. I mean, the ABC gave me money, so which means that now I have more money. Therefore, you're going to credit this liability. You're going to credit this liability because now it's increasing. But now let's say that at the end of 2 years, I then decide to pay back 50% of this money. Let's say I paid 50% of the 100,000, which is 50,000. I paid this. Now my balance of the loan at year 1, which was 100,000, has now been reduced by 50,000, which means that now I'm only owing 50,000 to Z Bank. Now this repayment of the loan is decreasing my actual balance, my actual loan. Therefore, we're going to debit it. We're going to debit it because it's decreasing our liability. Okay, fine. That's. I hope you understand that. So now let's get to our honest equity. Okay, now let's get to our honest equity. Our honest equity is comprised of income and expenses. So now it is said that our income decreases on the debit side, it increases on the credit side. However, our expenses are vice versa. Our expenses increase on the debit side and decreases on the credit side. So I'm going to make a very good example of an income and an expenses. Okay, before getting to that, let's define what an owner's equity is. I'll come back to this note. Okay, so owner's equity is the net worth. Is the net worth of the business at any given time. Or our owner's equity is our asset minus our liability. Okay, fine. Now let's go back to our income and our expenses. So now our income and expenses make up the owner's equity. For now, let's look at an example. An example. Let's start with income. Okay, fine. So now I'm saying that, for example, let me say that, okay, fine. Now ABC Clothing is selling, is close to us. It's selling is close to us. We are the buyers. We are its customers. Now ABC Clothing sold clothing items. So now what's going to happen is that ABC is going to get an income, is going to make money out of the sale. So now, since our income is increasing, we're going to credit the income. We're going to credit the sale because now it's increasing. So now when an income increases, we credit it, and then when it decreases, we debit it. So in another example of our expenses is, let's make example of water and electricity. So now let's say that ABC pays monthly water and electricity okay, fine. So now ABC is paying, which means that the money in ABC's account is now decreasing, which means that this is an expense. Okay guys, now let's look at an example of an expense. Now let's say that ABC pays monthly water and electricity for 10,000. So now we're saying that this monthly water and electricity of 10,000 is an expense. And then when it is incurred, you have to debit on the credit side because it's increasing. And then when you pay for this expense, you need to credit it on the credit side. You need to credit the payments, the bank, because now there's an outflow of money from your account. So it affects two accounts, which is your bank and your expense, which is water and electricity. So now you're going to debit your water and electricity and then credit your bank because your bank is decreasing and your expenses are increasing. So now since we're done with this owner's equity and expense example, let's get to our account classifications. So in account classification, I'm going to tell you guys what falls under asset, what falls under owner's equity, and what falls under liability. So under asset, we've got what we call our non-current asset and our current asset. So those are non-current asset, are asset that we're going to hold or that we're going to own for a longer period, for more than 12 months. And our current asset are asset that we're going to hold for at least 12 months. It can be 3 months, 4 months, 6 months, but it has to be a maximum of 12 months. So under non-current asset, we've got what we call our tangible fixed assets. Those are assets we can touch with our own hands, we can see with our own eyes, and they include our land and buildings, equipment, vehicles, and we also have our financial asset. However, under financial asset, we've got fixed deposit. You need to make sure that this fixed deposit is more than 12 months. If it's less than 12 months, it falls under your current asset. So now let's get to current asset, and under our current asset we've got our inventories, which includes your trading stock, your consumable stores on hand, and we've got your trade and other receivables, which include your debtors control, your accrued income or income receivable, and your prepaid expense. And then we've got your cash and cash equivalent. Now that include our money, your petty cash, your cash flows, and your fixed deposit, which is less than 12 months. Okay, fine. Now let's move to our liabilities. Liabilities also have two portions, which are our non-current liabilities and our current liabilities. And our non-current liabilities are those liabilities which are owed by the company to another company or person for a longer period, for more than 12 months, and the current liabilities are within the period of 12 months, within our financial period. So non-current asset includes your long-term loan. Those are loans which are payable maybe in 3 years time, in 2 years time, in 1 year and a half time. And then now under our current liabilities, we've got your trade creditors, your bank overdraft, your short-term portion of loan, and your accrued expenses, and your income received in advance. So under owner's equity, as we said that we've got our income and our expenses, and income includes things like sales, our current income, our interest income, our rent income, our discount received, our bad debts recoverable, our profit on sale of asset, our trading stock surplus, our provision for bad debts adjustment. And under expenses, we've got our cost of sales, our interest expense, our rent expenses, our salaries and wages, our stationery, our fuel, our packing material, our repairs, our influence, our advertising costs, our discount allowed, our telephone, our water and electricity, loan on sale of asset, bad debts, depreciation, and trading stock deficit. Okay, so thank you so much, guys, for joining me today. Don't forget to tune in to our part 2 of this lesson, where we will be doing examples of our rule of accounting and our account classification. So please don't forget to like this video, comment, share, and subscribe to this YouTube channel. Thank you.